Okay, good morning. It is 11 a.m. here Central Time, and if you're joining from the East, good afternoon. Glad to have you with us today. My name is Mike Rush, one of the sales directors and consultants here with Total Farm Marketing, Stuart Peterson, based out of lovely downtown West Bend, Wisconsin, where we've been for the last almost 40 years. So glad you're joining us today for the July edition of our TFM 360 overall dairy market review. So thanks for being part of it. And of course, if you're watching it at a later date on the recording, welcome as well. Using the same format as we usually do, going through some of the current dairy data, the product data, and talking a bit about the feed markets as well too. So a quick overview on some of the information and data that we look at, again, using the same format that we typically do. But as always, if there's requests for additional information, ideas for other topics for a webinar, let us know, reach out. We have plenty of information, plenty of resources to pull from, and like to help share that. And if there's specific requests, let us know. So reach out if we can be of assistance. All right, so for the next 30, 40 minutes, we'll cover some of this data and talk a little bit about some of the positioning that we want producers to be focusing on as they approach their marketing and revenue management. All right, let me turn off the video camera and move into what we want to talk about. So first of all, here's our disclaimer. Obviously, you need to read this word for word, study it, remember it. Just kidding. When we're talking about futures and options and prices, commodity price movements, obviously there's risks. There's risks involved in that, just like there is risks each day waking up on the farm. Prices go up, prices go down. Money can be lost, money can be made. So be aware as we're talking about futures and options and market price movements that there is risk. But of course, there's also opportunity to protect yourself and manage your revenue more effectively. One housekeeping note too, at any time during the presentation on your Zoom toolbar, if you pop that up or if it's up for you right now, there's a Q&A icon with two little thought bubbles. Feel free to open that up, type in a question, and hit send, and it'll be queued up for me at the end. And I'll cover as many questions as we can. And if nobody has any questions, I have one or two that have been brought about from conversations with producers over the last couple of weeks. So I'm prepared either way. But feel free to enter in any questions you have. And again, always reach out after the presentation if there's additional thoughts or questions. Okay, so two quick things before we jump into some of the data. One is just to talk a little bit about our qualification, my qualification, but our qualification as a company to be here talking to you and presenting some overview on the dairy market specifically. One of our flagship service and one of our offerings is our TFM 360 dairy. We also have a TFM 360 grain approach, same concept, just focused on grain versus dairy. But the emphasis here is to provide a revenue management approach and help build strategies for our clients to follow that's backed by math and probabilities and a lot of those math-based modelings rather than just outlook and opinion. Anybody can get an outlook, opinion, information. The problem is sometimes, well, the problem is always with humans, we'll use confirmation bias in terms of how we utilize that information. And that can be pretty costly, especially as something as important as your revenue, your livelihood. So more of a math-based modeling approach, using strategy, developing various scenarios and various strategies and pathways is really a much better fit. So we do this and we utilize through this TFM 360 dairy approach, we utilize a model farm philosophy, a hypothetical farm situation that we can make some decisions on and see how it's going to impact it and test different ideas for their effectiveness in managing revenue, and then pass it along to the client and help them customize it for their preferences and their situation. So that's really our flagship service, and it's meant to be more of a consulting guided approach, but utilizing the strength of a team to do all that behind the scenes number crunching and math modeling, which is tedious and is not for everyone as far as time and attention, but we do it well for the last 25, 30 years of our history. We like to leverage that into producers to effectively use it. But as we talk through that, obviously milk marketing has changed a lot over the years and likely will continue to change as the world evolves and the world demand and supply and demand evolves. And most importantly, we feel the best mindset for a producer is to focus on managing revenue, not just making decisions, but actually managing their revenue and how their decisions impact the overall outcome of the revenue. To do that, though, you need to be able to use a variety of different tools in order to effectively accomplish that for your operation. And sometimes those tools can be scary because you don't know much about them, but utilizing a professional to help you figure out when and where and how to use those tools appropriately is certainly key. So within the TFM 360 Dairy, we actually work as a team, and that team consists of professionals that are functioning together, all with different areas of expertise and different focuses, but come together as a team to really help develop the right recommendations and provide that holistic approach to marketing. And in the end, we want to be a one-stop shop to help dairy farmers know when and use the right tool at the right time. Okay, well, let me undo this. Okay, as we do this, the TFM 360 Dairy Services is made up of 3 separate entities. Now, for a client, it's a very seamless experience, but it's important to note that there's 3 separate entities under the TFM umbrella. The TFM 360 Analytics team, which is under the Stewart Peterson Incorporated aspect of our business, that's where all that deep dive analytic and understanding and modeling is done. Developing recommendations, having them tested, bringing recommendations on hedging and cash, supported with all those different analytic tools, proactive and dynamic, when to take action on milk, feed, fuel, cull cattle, in what increments, with using what basic tools. Obviously providing access to a customer portal where they can track their overall weighted average price and have a tracking of their decisions, where it's putting them each month and each year, and then obviously support that with different communication, phone apps, certain reports, and just making sure that everybody has access to information. So that's where the brunt of that, the time and effort and research is put together. Then the 360 consulting team, which is under the Stewart Peterson Group Incorporated entity, that's where the consulting side comes in. Each one of those analysts puts on their advisor hat and work with customers, with their clients on an individual basis, and build a relationship and help bring some personalization into the model farm recommendation to fit the producer's operation comfort level, provide education, ongoing support, guidance, helping them really put the recommendations to use and see the benefit. And obviously helping transact any futures and options positions in a hedge account as needed, but bringing all that advice together so it can become usable and functional for the client. And then the third entity is SP Risk Services LLC. That's the insurance entity of our business, where we can bring in recommendations to use the dairy revenue protection insurance in conjunction with the other tools, and obviously be able to write those policies for our clients as well. So those 3 entities make up the 360 service. Again, for a client, it's a very seamless view, but that's how everything is developed. In that 360 service, we do break things down into kind of 3 model farms as a starting spot. And this is all developed to help producers, find the right level of comfort and engagement with the tools and concepts that are being used. So there's 3 tiers. The Options Plus is a very conservative approach, taking the same trigger points and analytic tools, but using only fixed risk positions, such as put options or DRP insurance, keeping things very fixed risk and less exposure. Obviously, one of the drawbacks is there can be a little bit less reward on the market moves because of the positions we're using, but it does keep them more comfortable. And obviously the capital requirements to use some of those tools are a lot less. The blended model is looking at all the different tools that are available, but kind of keeping the more exposed positions, hedges or milk plant sales, anything that's marginable as far as a hedge position, keeping those to no more than 50% of the decision. So having a blended approach, we're looking at all those different tools. And then for some producers that are very comfortable, and we have a number of them, they want to be more aggressive, use more aggressive contracting, more aggressive straight futures hedge positions. Obviously, there's a bit more risk and a bit more capital exposure to those, but they can get themselves with a bit closer to the current market price floor. So again, it's not up to us to tell you which one you need to be in, but we want to make sure we have advice that's structured for everyone and their overall comfort levels, and help bring some education into the process as well too. Okay, as we jump into the markets now, first, let me just start by saying, obviously, coming into this week, before we started this week, milk futures were technically oversold for the last 5 weeks in a row. We've been in a downtrend, and some of the Class 3 contracts were down, $4 to $5 off their highs. And a lot of the technical indicators were in a very oversold territory. So with market conditions like that, it was expected that buyers would eventually come in and support the market at some point on any bullish news. And buyers did find a reason, as we start out this week, to push the markets a bit higher, as the spot trade was stronger than it had been as of late. Blocks were bid up about 4.5 cents on Monday, and barrels added about a 1 3/4 cent. Yeah, 1 3/4 cent. Butter continues to hold in a range between $2.90 and $3, and actually added 2 1/4 cents on Monday as well. So we saw some strength come in on the spot markets and the buying, which has been needed, welcomed, and obviously we need to look going forward what that trend could be telling us, or if it was just a bit of an oversold situation. And we'll jump into some of that. But let's start out with this. This is just a Class 3 market cycle, going back from roughly 1995 to current. And when we look at this, you can see early on there was a pretty cyclical nature to the milk market. Now this chart is smoothed out, which eliminates the gaps in the roll from one month to the next. So the price scale on the right-hand side is not reflective of current prices or what we've seen. It's just a way to smooth things out so you have a better overall view of the trend without all the gaps in the chart. So don't pay attention to the price on the side, but just look at the trends we see there. You can see in the 90s through the peak of 2014, Class 3 milk ran in a relatively consistent bull-bear market length. Average bull market was about 18 months. Average bear market was about 21 months. So it was somewhat consistent, and there was a lot of indicators when these markets would be turning from bull to bear, bear to bull, that were somewhat consistent, and we could not pattern it with prediction, but look for areas where the market was slowing down, getting ready to change. But then, since that high in 2014, we actually went into a 53-month bear market period. And that was exacerbated at the end with the trade war at the end of 2018 into early 19. So it kind of exacerbated that. And then following that 53-month bear period, we kind of went into a more of a shorter period volatile cycle. As you can see, we had the COVID-19 drop, and then shortly thereafter, a huge spike in the market with all the government buying, and then a setback for about 9 months, and we went into about a 10-month bull market up until a few months ago, or a month ago, or 2 months ago, until we actually kind of topped things out, and now have slid back down in the start of this bear market. So it's been short. The cycle has shortened, and obviously we're seeing volatility switch, high volatility and switch in trend relatively quick. So more monitoring needs to be done on what's causing some of this. Obviously things like government buying, COVID-19, the trade war, the war in Russia, Ukraine. You can't predict those things. You can't necessarily plan for them, but we can learn from how the market has responded. Okay, here's a look at the continuous second month contract, Class 3 milk. It was a big deal to get over that $20 hump right at the turn of the new year here, and this chart ended up hitting an all-time new high at $25.79, breaking above the previous record high from 2014, which was at $25.30. So the fallback recently has brought it back to kind of retest that $20 level on the downside, and so far that old resistance, getting over that $20 mark, has held as good support. Now, the caution point though is a break of that $20 mark to the downside would probably really sour the charts and add on some additional sell pressure. So it's holding good now, and we can look for a bit of a rebound, but we need to be cautious of that level going forward as well. Here's a look at the 2022 average for Class 3 futures, which peaked at 2380. This is a testament to the great year that Class 3 prices had put together so far, and the hedging and pricing opportunities the market had provided, especially noting that, the first 6 months of the year have already settled out. So we had a lot of strong ability to protect a lot of revenue with that aggressive move higher. U.S. milk production in June totaled just shy of 19 billion pounds, and that's up 0.2% from the same month last year. This is the first report this year to show a growth in year-over-year production. Now, state-by-state growth rates compared to last year are as follows. California was up 0.2%, Wisconsin was up 1.5%, Michigan was down 1%, Iowa was up 3%, Minnesota down 1%, and Florida down 7.5%. Milk production per cow had averaged just a shade over 2,000 pounds. That's up 20 pounds from the same month last year. Total milk cows on farm on this chart came in at 9.423 million head, which is about 78,000 less than June of last year, but up 4,000 head from last month. So a slight uptick from last month, but still behind last year's levels. The block barrel average hit its third highest point ever in this year, 2022, with a push above 240 a pound in both April and May, but has since fallen back beneath that $2 per pound mark. Demand remains in good shape, but the market is running into some burdensome supply situation, which has been increasing ever since COVID first hit, and shown by the bearish cold storage and dairy products reports as well. So a little bit of a setback, but again, still strong demand at this point. The spread now between cheddar blocks and barrels has gone from volatile to really oddly flat and almost near even in the past few months. So obviously over time, there's been a lot of volatility in block barrel average, and now we've kind of evened out and really are sitting very flat. Historically, though, this spread does not spend a great deal of time at that zero mark. So as we're hovering right around and sitting right around here, there's pretty good opportunity for this market and potential for this market to start to widen out that spread. So we'll be keeping an eye on that fairly close as well too. That could be a major mover for the markets. The global dairy trade auction from last week, July 19th, saw the GD price index fall 5%. Since the peak on March 1st, the index has dropped 23%, with only one of those 9 auctions trading above the previous auction's index. So sellers aggressively have moved powder in this week's trade, taking skim milk powder down about 8.6% and lowering whole milk powder prices about 5.1%. So we're seeing a bit of a change in the GDP block barrel average. Here's a quick look at GDT prices in blue versus the U.S. spot cheese prices in red, and the spread between them. Now this is from the last auction, so last week on the 19th, in which GDT cheese came in at $2.19 a pound, and that's well down from the high of $2.91 a pound from back on March 15th. Spot cheese closed at $1.99 in the quarter that day, and both have been trending lower, but we've closed the gap. So the gap between GDT prices and U.S. spot prices have really kind of come back together, which, over this period of time, it kept our product more viable and more attractive on the global market. As that spread comes back together, it takes some of that advantage away as those prices come back together. So keeping an eye on how this progression continues will be key in terms of looking for world demand coming to the U.S. market. Monthly cheese and cold storage at the end of June totaled just a shade above 1.5 billion pounds. And that's up about 5% from the same month last year, but slightly below the May 22 totals. By comparison, the amount of cheese in storage in June of 21 was 1.435 billion pounds. The spot whey market, this chart goes back to 2018. After hitting an all-time high on February 8th of this year, as you can see that top spike there, at 86.75 cents per pound. Spot whey prices have fallen hard in the recent months and pushed back below the 50 cent per pound mark. Now that the 21 lows are being breached, as we're kind of falling through those, the technical action continues to look very weak for the whey market. The second month class 4 chart hit an all-time new high for the second month contract in late March, settled back, found support near the 2014 high, which is here on the red line, and since has pushed into a new all-time high as well at 26.12. Now prices have kind of ebbed in recent weeks. We're still really holding that support line there from the 2014 highs. So what a run this market has had and gone off for almost 12 months now. So that's staying very very supportive and is one of the bright spots in the milk market. Spot butter has traded to or beyond the $3 per pound a few times on this run, but buyers have sat in the sidelines every time so far to try to take it higher. That being said, as of yet, $2.90 per pound has held on the downside in recent weeks. So that's supportive. This market is just trying to kind of, equalize out here without sitting back too hard. Solid demand and mostly neutral supply inventory setup. This market, it's tough to bet against until we'd see a demand falter. So again, another bright spot in the overall dairy complex. Now, that being said, there's been a large cut in GDT butter, and that does make U.S. more expensive on the world scale, especially with the recent rally in the dollar. So that could potentially be a turning point here in the coming weeks. So something we need to keep an eye on. And this is one of the indicators we'll be watching to see if things hold together or if we need to get more defensive. Similar to how we showed the GDT prices versus U.S. spot cheese prices earlier, this is a look at GDT butter prices in blue and the U.S. spot butter prices in red. U.S. spot prices have moved to a 53-cent premium over GDT prices. That's a big shift from earlier this year, and again, could start to see some world demand shift away from U.S. On the release of the auction last week on the 19th, GDT prices were $2.51 a pound, while CME spot closed at $2.94 a pound that day. Monthly butter and cold storage at the end of June totaled 331.8 million pounds, and that's down 20% from the same month last year, but it is up 3% from May of this year. By comparison, the amount of butter and cold storage last year, June, was 414.65 million pounds. A long-term bright spot for the class 4 has been spot powder, and that's been noted as well. This chart dates back to 2012. The market held an uptrend since the bottom was put in place in the spring of 2020. And when COVID hit, and prices have stayed between $1.70 and $1.90 for most of the entire year so far. So again, decent overall increase in price, and even though some topping action here, we're still holding together pretty well. Dairy exports obviously have been a bright spot for a couple of years now. If you look at each month on this graph, has the bars, and the bars represent the total exports for that year. The red line being this current year, and last year and this year, just strong exports on our dairy product, which has been great to see. Obviously, a lot of economic factors in play and a lot of world demand need in play. In May, the total was 262,000 metric ton. That's up a little bit over 12,000 metric tons, or about 5% from May of 21. So again, cheese exports has led the way higher on a year-over-year basis, and it's up 31% from 2021. And we won't get the June numbers until next week. Obviously, but the dairy export numbers are always a few months behind by the time it all gets tallied. But it still is a current bright spot, and we'll look forward to seeing if we can hold that trend through the rest of this year. For the first time since November of 2020, butter exports were actually down year over year. If you've tuned into the past number of these webinars, I mean, every month the butter percent was usually double digits higher, the last two single digits. But this is the first time we've seen an actual decrease year over year. And the likely reason for that is, of course, global butter levels have fallen quickly, where U.S. prices have stayed near multi-year highs. So we're starting to see that that price comparison with GDT really be come into effect. But cheese numbers were up 31%, whey was up 6% from last year. Here's a look at the trend of actual milk settlement prices between the classes. So in the blue line is class 3, the orangish line is class 4. In April, May, and June, class 3 had finished at 24.42, 25.21, and 24.33, while class 4 had settled at 25.31, 24.99, and 25.83 in those 3 months. So again, overall, a good, nice uptrend in milk prices, which has been hopefully keeping guys profitable despite some higher input costs. Here's a look at class 3 prices in blue and class 4 prices in red. Obviously, the biggest disparity with the government buying in 2020 caused class 3 prices to rise well above class 4. But back in November, class 4 prices did overtake class 3 and have stayed at a premium for this entire stretch. So the recent class 3 weakness has led to some solid premium again in class 4. So something to keep an eye on if this spread starts to come back together, but we're still seeing that good separation. All right, let's talk quickly about feed. Starting with corn, obviously last year's run up in prices, we fell back to the $5 level on the downside this past fall, and then a variety of things, and of course the Russia-Ukraine war, but that sparked the next rally, which peaked in about April on the front month and has fallen the past several months. So this is a relief for corn buyers, right? For dairy producers looking for opportunities to book feed needs into this fall and into early next year. So we need to keep an eye on this. Now, obviously, the $5 level has been a theoretical talking point for a while. So where we bounced off last fall, and obviously on the way up, it took us a while to kind of break through that. So opportunities in this range, we need to start thinking seriously about opportunities to lock in feed on any type of additional setback here. I'm sure we'll get a question on this at the end, so I'll save any other insight till then. But taking advantage of this break, or being ready to take advantage of this break, is going to be key, especially if there's any type of crop concerns or crop issues come fall. On the meal side, meal futures have been mostly flat in the last few months, trading between $400 a ton and $440 a ton. Historically, you can see how imperative that $400 per ton level can be for both support and resistance. If we break to the downside, it could open up a bit of a washout into fall, but it is offering a strong level of support at the time being. That's kind of a key indicator, that $400 per ton level on meal. So obviously a break below that, we need to be thinking more mindfully about where to start layering in some purchases. Okay. As we wrap things up, just a reminder of what good marketing should look like. And this is part of that philosophy that we build into the 360 Dairy Service, which is looking at things from a more of a revenue management mindset and building a strong weighted average selling price for our milk, and obviously on the reverse, a strong average buying price for our feeds. But talking about milk specifically, the solid orange line is just that typical trend change in the market. You have your peaks, you have your valleys, you have your transition periods in between, but you have ebbs and flows. You have high times and you have low times with price. And obviously, as a dairy producer, if you're just taking what you get each month, you're living through all this. You're getting the high of the highs and feeling great, and you're taking the bottom of the barrel and feeling horrible in those bear market periods. And again, the time frame between these has been changing. The point is, a good overall revenue management picture should be based on how to smooth out that volatility. So the dashed line would represent your weighted average price that you're building as you're making decisions to price milk, protect milk, defend price, and manage opportunity. Smoothing out the volatility, so your revenue, your average price for your milk, which when you factor it through is what your revenue would be based on, is not as volatile as the market. At the same time, keeping yourself as close to the tops as possible, while developing as much separation from the downside. So you're smoothing out the volatility against your revenue stream, and you're trying to be above that average point over time. That should be the goal. And the only way to do that is be thinking ahead of how to defend risk and manage opportunities. And it should go without saying, but I'm going to say it anyways. There's nothing you can do. Well, there's nothing responsible you can do to try to create this kind of separation from the price you're receiving and the bottom of the market when it's washing out. There's nothing you can really do responsibly to create that separation at this time when the market is bottoming out, unless you're taking on a lot of risk and a lot of trading and just being super aggressive and probably more speculative, okay? In order to do this, you need to be planning ahead and thinking when the market is at its top or at a high price, how do I look out into the future and defend conservatively the potential for a drop in the market, because it eventually will happen. At the same time, as I'm making those decisions, I have to make sure I know what I'm giving up. What's that cost of developing this kind of separation, and how much is that taking me off the high? And finding the balance that keeps you in the right level of protection and opportunity without costing too much, but keeping you in a very smooth and hopefully profitable position. That should be the goal, and that's what we build into the philosophy behind our approach. Now, to do that, to look at a weighted average price, it's a fairly simple math equation, but when you break it down, there's a lot to go into it to actually look at it, adjust it, identify it over times in the market. But the simplicity is this: how much of my milk have I priced for a given period? Maybe I sold it on a forward contract. How much have I hedged with maybe an option position, maybe a DRP insurance policy, because it acts as a hedge because the physical milk is unpriced? And then how much of my physical milk is totally unpriced? And just by looking at the ratio between what I've done, now here's an example. What if I priced 30% of my milk at the milk plant? I bought DRP insurance or put options on another 20% of my production. Well, together, that's 50% of my milk production for that given month or period that's covered to the downside. Well, then by law of math, I would have 50% that's totally unpriced. But actually, this 20% you hedged here with either DRP or put options, that milk is still unpriced. So technically, you have half your milk covered to the downside, and you have 70% of your milk open to the upside, because this 20% still has upside opportunity. And that's where you can find the right leverage to get yourself the right level protected to the downside and still have the right percentage open to the upside for opportunity management. Now, that's the simplicity of it. To get really involved in it, you need, and our team has a very elaborate spreadsheet calculator. Here's just a quick snapshot of it, but we can plug and play different option positions or DRP in terms of percent, how much we're paying for it, what coverage level we're getting. We can get creative and look at some of the different tools like fences and collars and min maxes, utilizing call options, selling call options, contracting milk, using futures. Variety of different things we can plug and play to look at what's going to give us the best overall situation in terms of the average price that we're building in this middle line here against potential outcomes in the market. What if we see $16 milk? What if we see $24 milk? Now, where this becomes very powerful, this is a very simplistic breakdown, but let's just say we had all of our milk covered and it cost us 30 cents a hundredweight to do that. Maybe it's a DRP position, 100%, maybe it's option positions or a combination. But the cost going in is 30 cents. Well, the simplicity of it is this, is saying, hey, if I spend that money and this market goes to $17, what am I averaging for my overall average price? Well, $18.68. So you're $1.68 ahead of a $17 settlement market. That gives you pretty good security. At what cost? Well, if we continue to rally, the most we're going to give up in this example, if we have it 100% covered with 30 cent cost, is 30 cents. So we see $24 futures, take off 30 cents of your coverage, and you're averaging 23.70. So that's a simplistic view of how to use math modeling. Now, where this becomes very, very helpful is when you're looking at layering in 20% of coverage at a time, or maybe using some DRP, some put options, maybe some milk plan contracting on different percentages, having all that in together and shelled out and computed to where's your average price across 100% of your milk, including the milk that's nothing's done with, and at what cost or what give up. That becomes very powerful to help you look at objectively, what am I doing? Does the position make sense? Is it giving me what I need to the downside without costing me too much to the upside? Now, these are things that we do on a daily and weekly level for our clients, and the kind of leverage we can help bring in, because it takes a lot of time, attention, and devotion to do this. And let's face it, most dairy producers just do not have that extra time, and probably don't really even have that extra desire or focus on this side of the equation. So if you have no idea where to start, but you're thinking, hey, this is something I probably should be looking at, what I'm suggesting is you contact us, contact me, and we have a free, no obligation assessment. Just takes maybe 20 to 30 minutes for some questions, and just get a good understanding of where you're at, what's working, what's not working, and it gives then you a starting spot with some explanation of what you can do and how you can start to develop a more strategic approach. So you can call me and do that verbally, or you can go to our website, and we have a 3-minute quick assessment just as a starting spot. Take a couple minutes to go through that, answer through the questions, and then again, that'll prompt a contact from one of us just to go through it and maybe fill in some of the gaps. But it's a good place to start. It's a good checkup on your overall marketing health. You do it on every other aspect of your operation, financial side, obviously procedure, and overall flow of cows through your facility and efficiency of milk production. You do these checkups periodically to make sure you're where you need to be. You should probably consider doing it on the revenue management side as well too. Here's a free, easy tool. There's no obligation, there's no hassle with it, but it can certainly help give you some right direction in how to potentially change or advance your approach. Okay, this final disclaimer, same thing we saw before, just need to wrap up with that potential risks and opportunities. And now let's see if we have any questions. Let me just see a few of you here yet. I don't see any specific questions. No, nothing came in as a direct question, but I do have, as I mentioned, I do have a couple questions that came up in the last week or two with conversations with dairymen. Now, one actually just yesterday, with feed prices falling, as we just talked about, off the highs, where should we start booking feed and how much? Well, obviously, we have some very specific technical indicators and trigger points based on, I'm going to go back a few slides here, based on our analysis and how we look at things. But if you look at the corn market, like I said before, generally speaking, if we get down, well, the $5 mark is a bit of a pretty talked about support level. So anytime we're down closer to 5 than 6, it probably makes sense to be booking feed. So generally speaking, somewhere below 550, we have some targets in place, and we need to be thinking about pretty aggressive positioning on purchasing feed for the rest of this year into at least the first quarter of next year, maybe the first 2 quarters. So that would be a target area. And now what we're looking to do is also back that up with a potential put option strategy to make sure that if this market just washes out, if things are rosy going out, demand falls apart, and we end up moving well back below $5, that we have some level of security. So figuring out the right put option without paying too much to make sure we have some downside coverage on that purchase decision, because obviously we want to make sure we're defending against a move back to $6 or $7, or I should say $6.50 to $7 if this market, if the crop ends up failing, or there happens to be that next wave of the bull market. So we want to be proactive, and we also want to protect the decision. Same thing on meal. Like I said before, a break below $400 a ton will look at several trigger points to be locking in meal purchases. I don't know if we have much in play to use put options, because getting down, if we get down to $300, that would be a pretty big stretch to the downside, and in recent years we haven't really seen ourselves stay down there very much. So, but that could change going forward. But a break below $400, we need to be thinking pretty aggressively about locking in meal. Okay, the other thing, the other somewhat question, or at least the content I want to share. I talked to a number of producers in the past few weeks who, for lack of a better term, get pretty ramped up negatively on all the data, and can they trust it, and who's manipulating the market, and things like that. And we all know somebody who, whenever you talk to them, has that type of attitude where, you know, they don't trust how things are being reported. They don't agree with how the markets are moving. They don't agree with high input costs. Some general feeling that things could be manipulated and we're not getting accurate data. How can you trust the data from the USDA? Things like that. And if you don't know that person, it's probably you. I'm just kidding, but we all know somebody who has a bit of that negative view on things. And, you know, human beings, human nature, rightfully so. There's a lot we can be frustrated on. But what I point out, and what I want to point out as we wrap up today, is we can focus on those things, all that data and the negativity around it, but we can't control any of it. There's nothing we can do to control today how the government reports things. We can certainly get involved with legislation and politics and try to fight for changes, and that's fine. That's great. Certainly commendable to get involved in those things, but we all know that takes years, decades to make any advancements. The point is, we have to start to focus on things that we can control. We can't control those things. We may not like them, but it goes back to the age-old saying of keep your friends close and your enemies closer. You have to understand, and sometimes the fear and frustration comes more out of lack of really understanding than it does the data being wrong. But regardless, we can't change the data. We can only work on, and we can only make decisions on, and the how we respond to it, or what decisions we make or you make to defend your overall revenue. That needs to be where you put your focus, rather than things you can change. Let's focus on the things we can control, which is when you make decisions, how much risk you take off the table, how you manage your opportunity going forward. So as we wrap up today, just keep that in mind. You know, make sure you're focusing on the things that you actually can control, and have some degree of control and decision making over. Okay, that wraps it up. We are at 11:41. Look at that, 41 minutes. So thank you for taking time. And again, if you're watching this at a later date, and if you are watching it live today, you will get sent a recording. So if there's anything you want to review, but certainly my number and contact information is up here on the screen. Reach out to me if I can be of assistance. Strongly consider, before fall activity picks up, taking time to do that marketing assessment. I think you'll find it very helpful and informative to give you at least the building blocks and somewhat of a pathway of what you can do if you want to work on increasing your overall approach and becoming more strategic, and learning how to create some better behaviors and practices that are more meaningful and focused on the things that you can control, which is when and how you manage your revenue. With that, thank you for taking time. Have a great rest of the week and enjoy the rest of summer. Take care.